Good afternoon, welcome to the TheoTRADE afternoon video. I am Blake Young. Today is October 19th, 2023. Today we're going to be looking at predicting the unpredictable, analyzing geopolitical risks and market performance. Now, a lot of times when I look at geopolitical risk, I want to go and take a look at how strong the Swiss franc is. But I want to focus today on the geopolitical risk in the Middle East, how that impacts oil, how oil prices impact the global economy, and certainly and specifically the U.S. economy. To start out with, let's take a look at the SPX. SPX, you can see this is a weekly chart. We've got weekly candles up here. And as you can see, we're bounced down, rolling down, and this is a widening candle. So we've made a higher high and a lower low this week. That expansion usually is an indication of a new trend emerging. So if this is a new trend and it's making a lower high, then we are breaking down and breaking out. As I look back here and looking at all this price action through here, these previous support and resistance areas, if you want to look at it from this perspective, there we go, get a little thinner line there. This is the previous support, resistance, support, resistance. So this is the same area that we found as a barrier just 2 months ago. It's the same barrier that we found back in August, going back to 2011, October, previous support areas, resistance. And so it appears to be a pretty good level as an inflection point or a pivot point, a reversal point, and it can go either direction as support or resistance. So it's a good area to at least watch for a barrier, at least a potential barrier where we're sitting. Now, that is purely from a technical perspective. What I want to look at is what's happening with inflation, what's happening with oil prices, and what we can expect to happen with oil prices and inflation with this geopolitical uncertainty. So to do so, let's first highlight our price ratio between the ES and the ZN. This is saying inflation adjusted somewhat, inflation adjusted ES, and you can see the ES is overpriced based on a risk-free premium of bonds, and that's partly due to the fact that bonds are selling off. But this is the highest level equities versus bonds have been at since 2000, and we can't really go back before then with the futures. So you'll have to simply look at this chart and understand that we've never been this high of a ratio. Equities to bonds, or in other words, equities versus that risk-free premium. That's a concern. We've never been here before. Now, as we go and look at crude, I want you to look at a couple of things here. And this is a long-term crude chart. And you can see the price action is adjusted. And we have this inflation adjusted. If we want to unadjust it for inflation, look something like this. I want to look at this inflation adjusted, saying, how is this impacting you and I based off our purchasing power? And so when we look at this, as we look at the current prices, we're near the highs. In 2000, 2001, we were climbing. We peaked out about 2008. There is the peak of the market, peak of the housing market right there. And we saw that oil prices were peaking out there as well, adjusted for inflation. You can look back here in 1980, and you might think this is just simply an inflation-adjusted chart. There really wasn't much going on. But I want to highlight a couple of things. When did we have conflict in the Middle East? Significant events. Now, we could go back to the 1960s and talk about the Yemen Civil War, 62 to 70. We could talk about the Arab-Israeli conflict going back to just post-World War II in the late 40s, early 50s, but that's continued on and on and on and on. That's really where it all started. Now, if we go into this and focus on the more recent stuff, the Iran-Iraq War, that started in 1980, right here. So oil prices reached a peak at the very beginning of 1980, right as the Iran-Iraq War started. That lasted from 1980 to 1988. And so we see there's a peak of 1980 all the way down here to 1988, and that's matching almost perfectly the Iran-Iraq War from 80 to 88. Now, if we jump forward a little bit closer in time, we're going to go forward to the Gulf War. The Gulf War was in 1990 to 1991. And you can see we had a spike here. There's your conflict, your spike peaks. And that was exactly, by the way, the peak here was when we began the Gulf War, August of 1990, spiked up there. Oil prices reached its peak, and then within that 1 year time frame, we dropped back down to normal prices. Now, we could look at the Iraqi uprising. That was from 91. That wasn't a conflict what we tracked down. But let's go ahead and jump over to 2001 when we saw the beginning of the Afghani War. Now, the Afghani War lasted arguably 20 years. So really, it started here, it rose, and that's continued to go on. The Iraq War peaked out in 2003 and ended in 2011. And as we're looking at all these moves, they are correlated to conflict, Middle Eastern conflict. Now, prices could be rising and falling back and forth, but look what happened during those exact same times. I'm going to show recessions now. There's your 1980 at the beginning of the Iran-Iraq war, and we saw a recession in the U.S. And it continued to slide. We had that continue through there, and we saw that bottom out in 88, and that was the end of the Iran-Iraq conflict. Gulf War, 1990, there's the spike and another recession. Now, that's just 2 for 2. Does that mean that every single time we have a conflict, we're going to have a recession? Well, the war in Afghanistan started in 2001, right here. We had a recession. Now, oil prices weren't super high, but we did have a recession, and then prices continued to climb up higher. As we go over and look to our current price action, as we're looking at the near term, you can see the oil prices spiked up to $100. And again, this is inflation adjusted. And we had our little tiny recessionary period in 2020 from the COVID lockdown, but could we be facing another recession? If oil prices continue to climb and we have more conflict in the Middle East, there's a higher likelihood that we will be going into recession because it will change the behaviors of consumers. Going back to our S&P 500 chart and noticing again that the S&P is overpriced compared to bonds, we can take this same idea and take bond prices and compare it to crude prices to get a sentiment of what that should be, or what the inflation adjusted view on crude is going to be. Now, this is the crude versus bonds. And as you can see, we're near the highs. We've been a little bit higher before, but we're near the highs. And every single one of these peaks saw a pullback shortly after. Now, we have this moving average here. It's a price ratio with a moving average, but we had the peak hit 2008. Anything over that 84, 85, and 91. So let's go back here. Anytime we got above, really, current price, about 85. So let's just zoom in here. 2008, anything above 85, starting here to here, what happened with equities? Anything above 85 over here, what happened with equities? And we'll zoom in on this here in just a minute. Anything above 85, anything above 85, anything above 85, potentially here. Now, as we're looking back at these different price actions, different moves through here, and we're going to make a comparison. Let's take a look at that as a percentage pullback after we got above 85, that ratio about 85. And so we saw this peak pull back to 59%. That was 2008, 2009. As we zoom over here, did this one pull back? Well, it did, even though it doesn't look like that's that big of a deal. And this is the one I like to highlight. 2011 and 2013, we had pullbacks and corrections in the market where most people didn't address it. That was a 20% correction. 20% correction. Really, if you go off the highest price to the lowest price, that was even bigger. This is, again, compared to the SPX, is about 21% after we crossed above that 85. So when we're seeing oil prices compared to a risk-free premium, in other words, an inflation-adjusted move in oil prices, do we see the pullback? Now, we had one that didn't, but we were also in the middle of quantitative easing in 2013. 14. As we zoom over here, we did see that, by the way, in the Russell. The Russell is more sensitive to inflation as well. As we zoom over here to the next time it went above 85, from the peak to the pullback, the trough there, 2022, 27%. So as we're pushing back now above 85, could we be looking for a 20 to 50% correction? The 20% correction says that the S&P should fall back down to 3683. So as we're looking at this conflict, it's not that unpredictable. If oil prices climb compared to bond prices, if inflation-adjusted oil is on the rise, and we're dealing with war, it doesn't mean positive for equities. A lot of times we think that the war is positive for the economy, positive for equities. It can get us out of a recession because it's spending, but it's not because of war. It's because of spending. The pullback occurs oftentimes because you cannot produce what grows an economy during war. And if oil prices continue to rise, then we are facing a significant correction or a recession based off of the major conflicts we've seen in the Middle East. Now, as we go take a look at crude, just jumping over here to crude for just a minute, as we look at crude prices making higher highs, higher lows, higher highs, higher lows, we did pull back through here, but we've had these pullbacks before. Now, this is automatically adjusted for the futures chart. And so my previous trend lines aren't quite where they need to be. So let's make a quick projection off of this as a new bounce and a move higher. As the percentage move has been, this, if you're an Elliott wave theorist, ran up 26%, 27%, pulled back from the high to the low about 10. As we bounced up here, we ran up about 26%, 25, 26%, and pulled back right through here about 12%. So if we're looking at this as a new bounce, are we looking at a 26, 27% rally? This would be an Elliott wave type pattern. We could be looking at this going from 1, 2, 3, 4, fifth wave. And the fifth wave could push us above 100 to 102, 103, 105 as we're looking at this next move higher. And if crude is going up to 105, well, let's just say 100. If crude is going to go up to $100 a barrel, what does that mean for retail gas prices? To get a better picture, we'll start with the retail gas futures, and let's take our price ratio again. Instead of looking at crude versus bonds to get inflation, let's get a ratio as far as crude versus retail gas. We edit this, we change, and let's put crude first and retail gas second, so it tells you roughly how many gallons we're going to get per barrel. That's a rough equivalent. Okay? Rough equivalent. And so as we look at this, we want to look at not just the current price action, because we really haven't rallied here. We've kept oil prices down, and that's partly because of the release of the strategic oil reserves. And the fact that retail gas prices didn't continue to move higher is because of that release of the strategic oil reserves. And we've already released a bunch of it. We don't have an endless supply. And so it looks like we're probably going to be heading back up. So we want to look at this as a historic ratio and look at where we've been over the last 10 years, 20 years. So let's go back with the futures, and let's go back 20 years, because we want to go back to look at that 2008, 2009. Retail gas prices compared to crude. You can see that that was in the 38, 39, 40 times ratio. And we can see that we stayed there for 2008, 2009, 2010, 2011, right around 40. And so as we're looking at this, we're moving this higher. Yes, that ratio is still pushing up here. And now as we adjust this, this is telling us that in the big picture, we are facing the correct ratios week over week. But if we're looking at this in comparison to crude, when crude was above 100, where was retail gas prices? Going back to crude, here's the $100 mark, and we see that we are talking about 2011, 12, 13, 14, all the way through back through here in 2008, 2009. And so the retail gas prices, where should we be? We should be roughly at the same levels that we had in 2008, 2014, etc., which means we should be looking at 320, 330, 350, which is another dollar higher. And as a percentage, if we see this recover and move up to match what we had back in the same 2011, 2012, 2014, then we should be seeing a 38% increase in prices. If you were at $4 a gallon when retail futures are at $2.36, when we move up to $3.36, you should be looking at $5 or more per gallon. If you were in California and you're paying $5 already, you should be looking at $6 or $7, and we should be seeing gas prices reach these higher levels that we saw in 2008, 2011, 12, 13, and 14. What will that do to your purchasing power? What will that do to your spending habits? Now, really quickly, I've taken 2 times the consumer discretionary and 3 times consumer staples as a pairs trade. This gives us roughly a 0% from back here 20 years ago. And so as we're looking at this, we're trying to look at the behavior that happened during that recessionary period of what happened to consumer discretionary versus what happened to consumer staples. Going back to the same 2008 timeframe and looking at this correction, as you see, ratio-wise, we saw it go from the 0 level, balanced out, in 2007, 2008, 2009 during the conflict and during the housing crisis. We went from 0 to negative 35, a 35% times multiple. So we pop it up here to look at the same pullback through here. We went from about -10 to -25, and we're looking at weakness in consumer discretionary and strength in consumer staples. As we zoom all the way over, even during the 2020 lockdown and the behaviors that saw a change in pattern, we went from about a high of 83 to a low of -15. And so that 100% ratio in that correction, when it's 2 to 3, are we looking for the same kind of thing? And it looks like we already are. We've already stabilized through here. If we see that type of correction, we could see this drop from that same ratio of 105 down to 20, 105, that'd be 80 points like we saw in 2020. And we really could see consumer staples outperform consumer discretionary, in which you would want to be looking at a bullish play. Now we could flip this around, the ratio around, so you can see it the opposite direction of saying during recessions I want to lean into buying consumer staples and selling consumer discretionary. And we just flip that to be buy consumer staples, sell consumer discretionary, same ratios. And now you can see, look, if I were buying down here, I would have gone from 0 up to 30. And again, it's hard to measure that as a percentage, but we're talking about hundreds of percentages when we're using a 1.5 times ratio. $100, $200, $300, so $1 invested, $1 placed on the table here would have become $30 during that same recessionary period. As we go over and look at the same bounce in 2020, this move, an investment of, well, it says -69, but we're talking about a move up from 69 to 13. So again, there's $80 move through there. And we could get a higher number here to get that, turn that positive. If you want to take a look at that as a positive number, we can just go to 2 to 1 to get that ratio to be a little bit more specific. In that lockdown time period, when we see a recession, even though small, very short-lived, we went from that 0 or $1 that became $33. So we're seeing 30 times here as well. Now, I don't know if we're going to be the same situation here, but if we're seeing that 30 times move in the favor of consumer staples versus consumer discretionary, that would be something closer to maybe a 5 to 2 ratio. And now we can see we went from, I'm not going off the lowest shadow, but from the price of about $60 up to 120. So there's a 200% gain. If you go off the shadows, we went from 22 to 126. There's a 5 times gain. So if we're looking here, $30, could we go 2 times? That would be 60. Could we go 5 times? That would be 150, favoring consumer staples over consumer discretionary. This is the impact, and the predictions and the market performance shifts from growth and tech and expansion to safety and defense, because consumers' behaviors of purchases change with conflict in the Middle East and rising oil prices. So that's what I'm going to talk about today, and that's what we're going to do, is predict the future with this geopolitical risk of higher oil prices and a market pullback and likely a recession in the next 6 to 12 months. That's going to do it for me today. Thanks for watching. We'll talk again next week.